In this video, I am going to show you how the rich legally avoid paying taxes with the buy, borrow, die tax strategy. There is a reason why some of the wealthiest individuals are able to pay close to 0% of their total wealth towards taxes, while everyone else pays up to 37% of their income towards taxes. Most people pay more taxes as they accumulate more wealth, while many billionaires pay less as their wealth skyrockets. And it's because this strategy allows you to build wealth, get cash when you need it, pay no tax on the cash you receive, and even pass down generational wealth down to your heirs tax-free. And I'm going to break down every step of this strategy for you for free as a licensed CPA that tax plans around things like this every day at mycpacoach.com. So go ahead and save this video, hit the like button below, and let's go ahead and jump right in. Okay, so the very first thing you need to understand is how your wealth is actually taxed. And it's very simple. Your income is taxed. Therefore, if you can avoid triggering income, you can avoid taxes. When you buy assets that grow in value, it is not income. When you borrow money against your assets, it is not income. And when you die, the transfer of your assets is not income. On the other hand, when you sell assets, it is considered income. Or when you earn wages, it is considered taxable income. The buy, borrow, die strategy is designed to avoid triggering what the IRS defines as a taxable event, all while accumulating more assets and getting liquidity when you need it. And there's really 3 easy steps to accomplish this. So let's go ahead and break this down, starting with step number 1, buying assets that appreciate in value. Now, this may be stocks, real estate, life insurance policies with a cash value component, or even a business that you start or buy. But whatever it is, it needs to be an appreciating asset. And here's why. When your assets rise in value, 2 things happen. Number 1, your wealth increases as your assets appreciate in value. So you probably already know that your assets minus your liabilities equals your net worth. So as your assets appreciate, so does your wealth. And number 2, you pay no taxes on the appreciation of your assets when you hold them. Or in other words, if you do not sell your assets, you will never pay taxes on them. This is why the ultra wealthy have over $8.5 trillion in unrealized capital gains. They own assets, they never sell them, and they use them as leverage to fund their lifestyle and future investments. And when they do earn income, they try to report as little of it as possible. Some CEOs literally take a $1 salary from their companies while accumulating millions, if not billions, in wealth. They don't want income, they want assets, they want equity or shares in companies that they own. And as their portfolio increases in value, so does their wealth. All of this allows them to accumulate large amounts of wealth while paying little to no money in taxes. And almost anyone can start working towards this by simply buying assets and building your portfolio one step at a time, regardless of where you are right now. But buying assets is simply not enough. You also need to be able to hold these assets long term, so long that you never really need to sell them. Typically, these individuals are looking for low risk, conservative investments that typically hold their value and they expect to appreciate in the long term, like index funds that track the entire stock market, for example, since the stock market has always gone up in the long term, or things like real estate or businesses with a long lifespan. In the financial world, we call this a buy and hold strategy, where we buy financial assets and we avoid selling them for any reason. So regardless of what the market is doing, regardless of where interest rates are, or where inflation is, or whatever the world is worried about, we don't sell. The rich never pay taxes because they don't sell their assets. It's that simple. But on the other hand, if you're day trading, flipping houses, or selling anything at a gain, you are going to trigger taxes, which would not work with this strategy. So the first step is to buy assets that you can hold long term. Now let's talk about how you can leverage those assets by using step number 2, borrowing against them. So when you need money from your investments, you really only have 2 options. Option 1, you can sell your investment assets and pay taxes on the gain. Or option two, you can borrow against those assets and pay no taxes at all. Now, borrowing against your assets is very attractive for a number of reasons. Like number one, first and foremost, your loan proceeds are not considered taxable income, which means that you would not be triggering a taxable event when you take a loan out against an asset. And then there's number two. By borrowing instead of selling your investment assets, you can keep those assets invested. As Albert Einstein once said, compound interest is the eighth wonder of the world. And as Charlie Munger once said, the first rule of compounding is to never interrupt it unnecessarily. Borrowing prevents you from interrupting the potential growth of your investments. To illustrate this, just look at this example from JP Morgan. Let's think very big here and say you had a $10 million portfolio and needed $3 million for whatever reason. Well, if you sold your investment for that amount, you would have less money invested, bringing your total return to $483,000. Whereas on the other hand, if you borrowed against your portfolio for the same amount like client B here, you would have more money invested, which would allow you to have more returns. In this scenario, the total return increased by over $148,000. And that does not even consider the fact that you can take the proceeds that you borrowed and turn around and invest them into other assets. Some people call this double dipping because basically you can use the same amount of money in two different ways. For example, if you have $100,000 worth of stocks, hypothetically, you could take a $50,000 loan out against those stocks to buy $50,000 more worth of stocks. So instead of having $100,000 working for you, you would have $150,000 of capital working for you. We also see people do this a lot with real estate. They will buy one property, build equity in that property, and then borrow against that same property to buy another property. Or you can buy one business, build equity in that business, borrow against that business and buy more businesses. This is why you hear billionaires like Grant Cardone and Robert Kiyosaki praising debt, because they use it to buy more assets that generate more income for them. But then there are skeptics who claim that this strategy does not address how the loan proceeds are actually paid back. But it's actually very simple. These individuals typically use the loan proceeds to buy more assets, which make them more income, and that new income can be used to pay the loan off while leaving them with higher returns most of the time and lower taxes. Plus, as a CPA, one of my favorite benefits of this is number 4. You can write off the interest expense on your loan. You do not get a tax write-off when you pay income taxes, but you can get a tax write-off when you pay interest expense on your loans. When you use loan proceeds for qualified business or investment use, you can typically deduct the interest expense on that business's tax return. And these deductions directly reduce the income that may be reported on your tax return, which may allow you to pay even less money in taxes. For example, in 2007, it was reported that Jeff Bezos earned $46 million in income, but was able to, quote, offset every penny of it with losses and deductions like interest expense. So yes, when you borrow against your assets, you do need to consider the fact that you have to pay it back and your interest expense. But you should also consider the after-tax impact of deducting that interest expense as well. If incurring interest expense means that you can keep your money invested, make additional investments on top of that, and avoid selling and paying capital gains taxes while offsetting other income at your tax return to pay less taxes as well, then it may be very well worth the expense. But to be fair, there are several other risks involved. There's interest rate risk, the risk of your investments actually underperforming, or other factors that could result in a sudden repayment of your loan or a loss of capital. So please carefully weigh this and consider getting a financial professional involved if you need to. But with all that said, we still need to address how exactly you would go about borrowing against your assets. And that's also quite simple, and it depends on the type of asset you own. And here are some of the tools that you may be able to use. So if you have a brokerage account where you invest into things like stocks, bonds, and other securities, you can use a securities-backed line of credit, also known as an SB lock, or portfolio loan, or a margin loan if you specifically want to buy more securities. If you own real estate, you may be able to use a home equity line of credit, or if you own a business, you may use a business line of credit or a secured loan. You can also borrow against permanent life insurance policies that have a cash value component. With those types of plans, usually a portion of your premiums are allocated to what is referred to as a cash value component. And once it reaches a certain amount, your insurer may allow you to borrow from it. And when you do receive those proceeds, it's typically free of any tax. Now let's discuss the final part of this strategy. Step number 3, dying, which has even more tax benefits, as weird as it sounds to say that, but let's go ahead and break this down. So when you die, someone will typically inherit your assets, right? And when they do, 2 things usually happen. Either number 1, your heirs will receive the assets at their fair market value, which basically wipes out your entire capital gain. For example, let's say you spent $100,000 to acquire assets that are worth $1 million when you die. Well, if you sold those assets while you were alive, you would pay a $900,000 capital gain. But by now you should know that you should never sell your assets under this strategy. So let's say you did not and you died and your heirs received those assets. Well, if they sold it for the same $1 million, they would pay 0 tax on that transaction because of something called stepped up basis. Your basis in the asset is the cost that you paid for it, but that basis does not transfer over to your heirs when they inherit the property. Instead, the assets they receive are typically valued at their fair market value at the time of your death. And I say all of that to say that if you never sell your assets, not only will you never pay taxes on it, but your heirs would not either in that situation. So talk to me in the comments below. What do you think about the buy, borrow, die tax strategy? Would you consider it or prefer to sell your investments and simply pay the taxes? Personally, I have more peace of mind when I don't take on debt, but I also recognize how beneficial it can be from a wealth and tax perspective. So hey, if you enjoyed this video, please hit the like button below, share this with someone that you know. And if you need immediate assistance, like right now with your tax situation, just go to mycpacoach.com to apply to work with my team today.